give about a brief about myself. I'm a director at a software company, which is basically my company itself, where we do machine learning and cloud computing. We are also fund managers. I'm a SEBI registered investment advisor. For 8-9 years, I worked as a research person, equity research person, and from last 4-5 years, I'm more of a retired person. I take a lot of lectures. So from 2010-11, I'm taking lectures. And to be really frank, I'm taking FRM for the first time. I have taken CFA almost for 6-7 batches. So CFA is not an issue. FRM, I'm taking it for the first time. So be gentle on me. Anyway, yeah, so let me share my screen and we will actually move ahead. Few ground rules. I request it to be an interactive session rather than a monologue. So if you can ask questions in between, if you have any doubt, you can just stop me there so that it will be easier for me to understand the speed and level by which I should be moving on. So I request all of you to try to make it as interactive as possible. So let's start. So let me share my screen. Okay, I hope all of you can see my screen.
Yes, sir, I can.
Thank you very much. Thank you very much. Okay, now what we are going to see today is basics. So nothing great about it, just basics of risk management and all theory. I will try to give you some examples and some interactive Excel things, how to calculate VAR and other things, but mostly it will be a theory one. Now, yeah, let me use my pen also. Right. Okay, I hope you can see the color coding by pen also.
Yes, sir.
Perfect. Thank you very much.
Yes, sir.
Yeah, so FRM is basically classified in 4 different books. First book speaks about foundation of risk management. Second book speaks about cons used in risk management. Third book speaks about products used in risk management. And fourth book speaks about valuation and models also used in risk management. Now, FRM level 1 is very simple. Just study for 150 to 200 hours, and I'm quite sure you all can pass. Now, before actually moving to key concepts and all that, I would like to ask you some basic terminology, whether you know that or not, so that me to move ahead. So, guys, do let me know. Have you heard about standard deviation? Anyone? Do you? I just want to know whether you know the concept or not. Then normal distribution. Good. So you guys are not saying anything, so I assume that you know all these things. So I'm moving ahead. So in this chapter, we are going to see about general risk management process. What is difference between expected loss and unexpected loss? Then we will see about various types of risks. Now, first of all, let us see about introduction. Now, various people have different notations about risks in their life. Some people feel that risk is uncertainty. Some people feel that it's financial loss. Some people feel that it's not a financial loss, it's overall loss. Now, when we speak about risk in financial terms, now in financial terms, risk means deviation from the mean. Sorry, deviation from mean. Now, first of all, let us understand what mean means. Means is nothing but average. Now, any deviation away from average, no matter whether it is a positive side or whether it is a negative, any deviation is a risk. This is from financial part. Now, what is difference between risk and uncertainty then? So, anything which can be measured is called risk. Now, the loss which cannot be measured is uncertainty. Now, so giving an example, we know that okay, if market falls by 20%, we are going to make loss of approximately 10 million. This we know from the history. But people could not find out the probable loss due to COVID, which happened in 2020. Now, the loss happening due to COVID comes under uncertainty. Now, if every year or if after every couple of years, you will find that, okay, the things like COVID is happening every couple of years, then it will become a risk. Till then, it will become an uncertainty itself. It will remain uncertainty itself. Now, next point is risk management and risk taking. Controlling the risk is risk management. So, deciding which risk to take, which risk not to take, that is risk management. And risk taking is taking active exposure to the risk, is risk taking. So, banks do take financial risk by lending money. That is risk taking because that is their business. They know their business, they know in and out, so they are ready to take that risk. So that's the difference between risk management and risk taking. Are we clear till this?
Yes, sir.
Perfect. Thank you. Okay. Now, there is a risk management process. So how do you manage risk? There are steps in risk management. So first step is identifying the risk. Second step is measuring the risk. Third step is distinguishing between expected and unexpected risk. Then first step is finding out the relationship between various risks. Next step is finding out how you can reduce the risk. Mitigation is reduction of risk. And then you need to monitor it and you need to give feedback. That is the complete loop of risk management process. Now, here in FRM, you need to focus more on concepts rather than uh, mugging up, okay, that these are the 5 or 6 steps. No, you're not supposed to mug up. You should understand the concept properly so that things will be easier. Now, there you have risk identification methods. How do you identify the risk? One is definitely brainstorming. Yeah. So Higher management, they sit together, they brainstorm, and they find out various risks. But that's an old story. Nowadays, even people from lower management, people from blue collar, they are also asked to come and brainstorm for risk management. Then surveys, then frontline person. Yeah, these are the blue collar person. Industry level resources, loss data analysis, scenario analysis. We will see this in detail afterwards. Now, what are the challenges? Risk never comes alone. So it is said that uh, if your bad times comes, it brings a lot of problems together. If your bad time comes, at the same time you will find that many others from the industry are suffering with the same issues which you are suffering. So that is concentration of risk. Many times you cannot prevent market disruptions. So this is basically market risk. Market risk is the risk which you cannot control. I'm going to come to that. That is market risk. FRM started only because of the accounting fraud which happened, to be really frank. So people started really worried, getting worried about risk management, and therefore GARP started with FRM. And then complexities of derivative product. I hope you know what are the financial derivative products. If not, we will see them in detail also. But basically, these are hedging products. Hedging means reduction of risk. Derivatives are generally used for reduction of risk, at least by institutional investors, not by retail investors, but by institutional investors. Okay, measuring and managing the risk. Okay, so before actually moving here, I would like to take you to the Excel sheet. Let me see if I can do that. Yeah, I hope you can see my screen.
Yes, sir.
Thank you. Okay, now look, here is the data of two cricketers, Dravid and Sehwag, and they have played 10 matches. I have calculated average of both Dravid and Sehwag. Can you tell me here which cricketer is more risky and why?
Here,
Yeah.
myself, Shomojit, here,
Yeah.
my point of view, Sehwag is risky
Okay.
because their consistency level is not up to the mark. Because
Perfect.
Dravid consistently doing a good number in every matches.
Perfect. So you speak about consistency. Yes. And how do you measure consistency?
Uh, because the fluctuations of their number
Yes, I could see
score.
that there's a lot of fluctuation in the number of Sehwag, wherein he
Yeah.
came, he scored 105, then 0, 10, 0, 111. There is a lot of fluctuation in Sehwag,
Yes.
and there is very less fluctuation in Dravid. That's absolutely bang on. But
Yes.
is there any way to measure the consistency?
Because of averaging of the Dravid scores, uh, in every matches their standard number is around 40 plus.
Okay, perfect. Yeah. So, guys, please remember risk is opposite of consistency. Now, and how do you measure the consistency or risk? You measure it with the help of standard deviation. Now, in Excel, you have direct formula to calculate standard deviation. You just calculate the standard deviation of Dravid came out to be 11, while standard deviation of SEVAC came out to be 50. So this is what risk is. Risk speaks about non-consistent performance. So the standard deviation of Dravid is very low as compared to the standard deviation of SEVAC. And therefore, SEVAC is more risky than Dravid. Got my point? Now, I'm not going in detail and I'm not going to tell you how you calculate standard deviation. That's a basic cons. But standard deviation measures consistency. So lower the standard deviation, higher is the consistency, or higher the standard deviation, higher is the risk. Now, there
So,
are
sir,
yeah.
Means standard deviation is lower means low risk.
Yes, you're
Standard
correct.
deviation is higher means high risk.
Perfect. So, guys, I request you kindly, while asking question, kindly just tell your name so that it will be a more personal thing. Yes, you are correct. When standard deviation is low, that means low risk, and when standard deviation is high, that means high risk. Now, there are two more terms: variance and correlation. Variance is nothing but square of standard deviation. And variance by itself do not tell you anything. It is just used to calculate standard deviation. Wherein correlation tells you that if one person is doing well, how is second person is doing in relationship with the first person. Now, this is from Dravid and SEVAC point of view. I will tell you correlation from, let's say, S&P and Nifty point of view. Now, if the correlation between S&P and Nifty is 0.5, what does that mean? If S&P increases by 10%, there are chances that Nifty will increase by 5% itself. That is 10% multiplied by 0.5. This is in long run. Not every time it happens, but it happens in the long run. So correlation speaks about relationship of two securities with each other. Similarly, we use beta. So beta speaks about relationship of one stock with the market. Now, if we look from Indian point of view, our market is Nifty. And let's say I am taking Infosys. Now, if the beta of Infosys, just a second, it's not going down. Yeah. Now, if the beta of Infosys is 1.2, what does it signify? It tells, sorry, beta of Infosys is 1.2. What does it signify? It signifies that if Nifty increases by 10%, Infosys will increase by 10% into 1.2, is equal to 12%. Beta speaks about the relationship between market and a stock or your portfolio. Correlation speaks about two stocks, two markets, two bonds, any two securities. and standard deviation speaks about risk of a particular security. Okay, now before actually moving ahead, let us see about normal distribution also. Okay, now we have seen standard deviation. One of the drawback of standard deviation is that it assumes that the underlying data is normally distributed. Now, there are different types of distribution. You have binomial distribution, you have Poisson distribution, you have log normal distribution, and normal distribution, which is also called as Gaussian distribution. Now, it is widely assumed that stock market returns are normally distributed. Here, I have taken a data of S&P from 1928 to 2021. Now, if you see, I have just taken adjusted close. What we are going to do, we are going to calculate returns. Today's value divided by yesterday's value minus 1. Okay, these are the daily, sorry, these are the daily returns. Now, what I'm going to do, I am trying to find out how much daily return it has given from 1928 till date. So let's start with minus 8%. Then I'm just trying to increase it by 0.3 will do. Okay, and let us drag it. 1.9. Fine. So from minus 8 to plus 8. Daily returns. I'm just taking daily returns. One more I will take just here. Mouse is not working. Just give me a sec. Command. Yeah. From minus 8 to plus 8. Now, these are the means, and I'm trying to calculate the frequency now. So array data is this, comma, pin data is this, and something wrong has happened. Just a sec. Array data has been taken care of. Let me do it again. I think some mistake happened. Equal to frequency. I'm trying to calculate frequency. This is my data, comma, this is my pin arrays. I had just shifted to Mac from Windows, so it's getting difficult. Control Shift Enter. Command Shift Enter must be there. This is an array formula. So Command Shift Enter. Yeah, got it. Insert recommended chart and take this. Okay. Look at the chart here. Now, near the mean, which is almost 0%. Yeah, 0.20, 0.1. Assume this is the mean because 0%. So let us calculate the mean also if we want to check whether maximum value comes near mean or not. The mean is 0.03, which is approximately close to 0.1%. Okay. Now, normal distribution, if you see, normal distribution is nothing but a bell curve, which is symmetric about the mean. And it will try to move away. Now, the standard normal distribution curve will say that if you go one standard deviation away from the mean, we have seen how to calculate standard deviation. If you go one standard deviation away from the mean from to the both side, 66.28% data comes in it. If you go two standard deviation away from the mean, you cover almost 95.44% data. If you go three standard deviation away from the mean, you cover almost 99.72% data. Now, I hope you understand what 6 sigma is. So, sigma stands for standard deviation. You go 6 standard deviation away from the mean, and that is 6 sigma. So, let's come back here. I'm using the word, it is assumed that the returns are normally distributed. They are not completely normally distributed, but it is assumed that they are normally distributed. Now, we have calculated return. Let us try to calculate standard deviation of all the returns. Let's take it in percentage. Okay, perfect. Now, as per the definition of standard deviation, or as per the definition of normal distribution, you have almost 99.72% of the data in mean minus 3 standard deviation. So what we will try to do, we will try to do mean plus 3 standard deviation, and we will try to calculate mean minus 3 standard deviation. How you calculate that? You have mean, you have standard deviation. So I will take mean plus 3 multiplied by standard deviation, comes out to be 3.62, almost 3.63%, and mean minus 3 into your standard deviation. That comes out to be minus 3.57%. Now, how do you read this? You are 99.72% sure that daily returns of S&P data will not go beyond plus 3.63% and minus 3.57%. How sure you are? You are 99.72% sure. And that's how you understand normal distribution, standard deviation, and returns. Now, with that background, let's come back to our presentations. Now, how do you measure the risk? I told you the best way to measure the risk is standard deviation. Now, nowadays, VAR is taking over standard deviation. Now, what is VAR? Now, let us understand how VAR came into picture. Now, VAR is a risk measure which is given by JP Morgan. Now, what happened is that the board of directors of JP Morgan could not understand the daily risk report which they were showing to him. And he wanted something simple which he can understand or which they can understand because they were bored. Some of them were not from finance background. So they came up with the new concept called value at risk. And what does this signify? Value at risk tells us at a given confidence level, let's say 95%, how much is the value of loss. That means, let's say we are trading daily and I want to find out that how much will be my daily loss. Now, I cannot calculate 100% that how much will be my daily loss. So what I will do, I will calculate VAR. How do you read VAR? At 95% confidence, I am sure that my loss will be less than 100,000. Let's say dollars. Now, they understood that we are 95% sure that on any particular day, my loss will not be more than 100,000. So in VAR, two things are important. First is this confidence interval, and second one is the value. Now, value can be in percentage also, percentage of your portfolio. And this is your, now, you can read VAR in another way also. I am 5% sure that my loss will be more than 1 lakh dollars or $100,000. So I am reading VAR in two ways. Please understand what is VAR. VAR tells us how much loss you are going to incur at a specific confidence level. How much loss you are going to incur at a specific confidence interval. Now, let us see. The value of VAR of 100,000, what does it signify at 95%? I am 95% sure that my loss will not increase more than 100,000. But if you subtract 95 from 100%, you will get 5%. So you can say, I am 5% sure that my loss will be more than 100,000. How much more? That we do not know. So this risk measure is very easy to understand. Just keep 100,000 aside and trade daily, because you are 95% sure that you will never breach this $100. Not never, you are 95% sure that okay, you will not breach this level. But once it get breached, how much will be the loss? That is not known, or that we cannot calculate using VAR. Now, there are various methods of calculating VAR. First is historical method. Second one is normal distribution method. And the third one is Monte Carlo method. All these three methods we are going to study, but in the next book. Right now, we are just understanding the basics. So, what is more important is we should understand what VAR is. VAR is a risk measure which asks how much loss you are going to incur at a specific confidence level. Okay, any questions here? VAR is a very important concept. If you do not understand, it's right time to ask. Perfect.
So, sir, Shomujit,
Yeah, so much.
so value of risk is basically that uh, if any of the stocks in the stock markets, that I am assuming that these stocks may be fluctuated in the historically, that is 5 to 10%. So I keep in the mind and take a amount for my measurement that it not more than be 10% if anything happen in drastically in the market or the environmental, any issues like COVID. So is it kind of understanding?
No. So it's not about you taking out or you keeping 10%. VAR is calculated from the historical data, right? So
Okay.
let's say that you have taken an example of shares. So every day you are trading in the share market. Now, there can be days where you will earn profits. There can be days when you will earn loss. As a retail investor, you do not keep money aside that, okay, this much money I'm keeping aside for loss. But when you are an institutional investor, you need to find out how much money I should keep aside so that my losses are getting covered. For the same reason, I try to calculate VAR. Now, if VAR tells you that, okay, there is 95% chance that your loss will not go more than 100,000. Then you take out this 100,000 and keep it aside for a rainy day. That agar kuch loss ho gaya, if some loss happens, then I have this money which is kept aside, and my regular operations will not be impacted.
Okay.
Could I answer your question?
Yes, yes.
Perfect. Anyone else? Any other question? Good. Okay. Let us move ahead then. Okay. Now, the money which is kept aside in order to cover your losses are called economic capital. You got my point? The money which is kept aside to cover your losses is called economic capital. Now, how do you assess the risk? There are two methods to assess the risk: scenario analysis, stress testing. There are more also. So in scenario analysis, I am not sure whether you studied it or not. We take three scenarios. We take bad scenario, we take moderate scenario, and we take good scenario. In bad scenario, the losses can go up to 55%. In moderate scenario, losses can go up to, let's say, 20%. And in good scenario, losses can, there are no losses. Assume there are no losses itself. So, we try to give probability that, okay, 20% is bad scenario. There are chances of 20%. 60% or 0.6, 60% is chance for moderate, and 20% is again chance for good. And depending on that, we try to find out different scenarios, and that is scenario analysis. We will see in detail when we do risk assessment. Stress testing is just changing one parameter and trying to find its impact on our profitability or on our loss. So, uh, from an manufacturing point of view, let's say if sales increase by 10%, what will be the impact on profit? Or if sales decrease by 5%, what will be impact on profit? So when you change just one parameter, is called uh, sensitivity analysis. My mistake. Third one is sensitivity. Sensitivity. When you are just changing one parameter, here I am changing cells, then you call it as sensitivity. When you are trying to change couple of parameters, let's say sales, operating cost, your tax rate, then you call it as stress testing. So you have scenario analysis, stress testing, and sensitivity analysis. These are risk assessment tools. Now, always remember, risk should not be measured for just one department. It should not be measured for just one manager. It should be holistic. And it should be measured for a complete company at an enterprise level. And it should be measured by high level management and not by some low level management. Okay. Now, two more things which we all should learn, that is expected loss and unexpected loss. Now, expected loss is the loss which we can calculate. Now, the formula of expected loss is probability of default multiplied by loss given default multiplied by exposure at default. But don't worry, this is just a formula you should know right now. In book 4, we have the calculation of all these things. Probability of default, PD is probability of default, LGD is loss given default, and EAD is exposure at default. Now, if you multiply these three things, you get expected loss. Simple. But many a times, expected loss is not like this. It fluctuates. And the fluctuation from the mean expected loss has increased here. Now, this fluctuation from the mean is called unexpected loss. So loss are two types, expected loss and unexpected loss. So the mean loss which we calculate, mean loss, is called expected loss. And any deviation from the expected loss is unexpected loss. So the idea is unexpected loss is nothing but deviation from expected loss. Any deviation from the expected loss is unexpected loss. Now, again, we do not have calculation as of now. We just should understand what are these concepts. Now, If you see this diagram, this is expected loss. Beyond expected loss, you have unexpected loss. Then you have known unknowns like earthquake or maybe riots. And then you have unknown unknowns. So COVID was one of the unknown. Now it is known unknown, but that time it was unknown unknown. So these are all loss categories. We will be focusing mainly on expected loss and unexpected loss. Okay, let us move ahead and understand what are various types of risk. As per FRM, the risks, major risks are market risk, credit risk, and operational risk. That does not mean that other risks are not there, but the major focus is on these three types of risks. So if you go on a FR level 2, you will have one book on market risk, one book on credit risk, one book on operational risks. Now, legal risk, business risk, and reputational risk are covered in operational risk itself. Liquidity risk is again covered in operational itself. So therefore,
Sir,
yeah.
Somyajit has raised his hand. Somyajit.
Okay, guys. Unfortunately, when I am sharing the screen, I cannot see the hand. So you can directly start speaking, guys. Please.
Okay, sir. Just before the types of risk, that is, one is unexpected loss and
Unexpected.
unexpected. So deviation from expected loss, it means the unexpected loss.
Perfect.
Like, so what is the example of the war between Russia and the Ukraine?
Yeah.
So this is beyond the unexpected loss.
No. So what happens is that when Russia started war with Ukraine, or even before Russia started war with Ukraine, we had an idea that war is going to happen. And
Yes.
people, as war is not new, people can calculate what are the risks involved in the war. So if there is a bank, if there is an US bank working in Russia, they know what's the risk involved in Russia. And they know that, okay, maximum what will happen, that I need to close my Russian arm. In my Russian arm, I have $50 billion. And if war happen, I might have to lose this $50 billion. Out of this 50, let's say my expected loss is 30 billion. And I strongly feel that 20 billion, I can take it back to US.
Okay.
Now, this 30 billion is your expected loss because you have already calculated this. Now, sometimes what happens, your loss might increase due to nuclear weapons, chemical weapons used by Russia, and your loss increased from 30, let's say 40 billion, because
Okay.
US did not give you time of 15 days to get your money out of Russia. So this 40 billion, so 40 minus 30, this 10 billion, this extra 10
billion.
billion is your unexpected loss.
Unexpected loss. Okay.
Got my point?
Yes, sir. Yes.
Yeah. Any more question, guys? Fine. Let us move ahead. So, three major types: market risk, credit risk, and operational risk. Now, first is market risk. The risk which is beyond our control is market risk. It's as simple as that. The risk on which we do not have any control. Fed changes its rate, equity prices goes down by 10%, 15%, which is not in our hand. Now, you are a very good company, but COVID happened. Or you are a bank, you have given very good loans only to salaried people with the, let's say, 1 CR is the value of the house. You are just given loan of 70 lakhs, only 70%. He has a very good EMI, he has very good salary coming. You have given all the good loans. And then recession came. What happened when recession came? You lose most of the people paying the EMI to. It's not your fault that recession came. It's not your fault these people lost their job. But still you are suffering. And that is exactly what market risk is. Now, when the whole market suffers, then only we call it as market risk. When only you suffer, we do not call it a market risk. When only we suffer, we call it as a credit risk. So, let's look from a bank point of view. You gave a loan of $100 and the person did not pay you back. That is the credit risk. Now, the credit rating agencies has downgraded you. So first you were getting loan at 8%. Now they have downgraded you. So now you will get loan at 12%. This is credit risk. What is happening in credit risk? Only you are getting affected. Either your customers are not paying you, your financial position is deteriorated, your liquidity position is. So credit risk mainly speaks about the losses you are suffering because of your own business. Either your customers are not paying you, which is called as counterparty risk, or you are downgraded. That is credit risk. The third type of risk is liquidity risk. Now, guys, please remember, companies do not fail because of profitability. Companies fail because of liquidity. Now, we have case studies of different companies in FRM. There is one company who had almost 4 billion shown as cash, and still they could not pay 150 million loan. And therefore, this company got bankrupt. Now, this was a fraud actually. There was no 4 billion there in their actual bank account. Just on the balance sheet, it was shown as 4 billion. Now, liquidated risk is not having cash when you're supposed to pay it. I will give you one small example of liquidity risk so that you can understand. I'm a consultant to many manufacturing companies, and one of the small company was a paper cup manufacturing company. Very simple business plan. So you get raw material at 40 paisa. The paper, the cup producing cost is, let's say, 10 paisa. All other overheads, including interest, was 20 paisa. So 40, 50, 70 paisa was the total cost. And they were selling one cup for 1 rupee. That is 100 paisa. So 30 paisa was his profit. And he was doing really fine, wherein he was producing some 20,000 cups per day. And suddenly he got an order from IRCTC or Indian Railways of giving 10 lakhs cups per day. He was very happy that he got such a big order. He purchased almost 10 more machines and he took a loan from a bank for purchasing raw material and other things. For the first month, he could complete the order. The loan was of almost 10 CR approximately. For first month, he could complete the order. Second month, he could complete the order. But what happened is IRCTC did not pay him after 45 days, which was supposed to be paid by IRCTC. I'm not sure whether it was some bribe issue or something, but in the contract it was written they will pay after 45 days, and they did not. In the second month, he could not pay to his salary. In third month, for 15 days, his worker worked and they stopped working after third month, when they find out that it's not possible for him to pay. And IRCTC still did not pay after 90 days. After 90 days, the people from electricity MSCB came and they cut his meter. And he had to shut the complete operation. In the fourth month, IRCTC paid him the complete amount, but then it was too late. When he got his money back, he paid his working capital loan, CC, OD. And when he tried to renew his CC and OD, bank rejected, saying that your credit score is not good. Was there any issue with profitability? No, there was no issue with profitability. There was just an issue with liquidity. It was quite normal for an IRCTC or any government organization to delay payment by a couple of months. This he was not knowing, and he thought he will be getting payment after 45 days. He could not manage his working capital, and therefore he failed miserably. The loss was more than 20-25 lakhs, and he could not come up to that level again, not even to 20,000 cups per day. That's the basic liquidity risk. Let us speak about operational risk. Now, if you see 2012, yeah,
Sir Shomojit,
yeah,
liquidity risk is basically linked with manufacturing sector or in the service sector too?
I will give you an example of bank. Will that work?
Yeah.
Yeah. So I do not remember the year, but P. Chidambaram was finance minister of India. What happened? A politician went in Chennai to take out money from ATM from an ICICI bank. Or I think it was ICICI. 99% it was ICICI bank. Out of the money which he has taken out, one note was a fraud note. He went in the bank. The bank manager did not change the note for him. And he was well-known politician. So next day, in his own newspaper, the newspaper which is owned by the politician, he wrote, fake notes are coming out of ICICI ATM. Is ICICI bank is going bankrupt? And question mark. What happened? Next day, many people started withdrawing money from an ICICI bank all over Chennai. Now, if you see, bank only keeps 8% cash of their total deposits. Now, people started withdrawing money from ICICI bank in queues from net banking. So next day, net banking was closed of ICICI. And this created more panic. And everybody started withdrawing money from ICICI bank. Next day, Chidambaram had to come on the national TV and had to tell everyone that ICICI Bank is not getting bankrupt and you should not worry about your money. What is happening is that because there was run of, how does bank works? Bank takes deposit from individuals and give loan. And in between they keep commission. So if bank takes 100 rupees as deposit, they try to keep 20 rupees with themselves and they give loan of 80 rupees. And this 80 rupees loan is of long term, right? 5 years, 10 years, 15 years, and so on. So
Yes.
everybody today itself go to the bank and ask, give me my money back. Bank will not be able to give it back, right? And
Exactly.
that is a liquidity risk of bank. If everybody goes today itself to one bank and ask, please give me my money back, bank will collapse. And that's the biggest liquidity risk of bank. You understood this?
Yes, sir. Yes, sir.
Yeah. So
Thank you.
liquidity risk is for everyone, not just for manufacturing, even for services sector, industry also. You need to manage your finances. So if an IT company invests in government bonds, which is fine, but there is very less liquidity while withdrawing unless you wait till maturity. So he purchased government bond for 100 and now he wants to sell it. And people are saying, okay, we are only ready to give you 80. This is liquidity risk. This is liquidity loss. Even with, this is exaggeration, 100 to 80. But yeah, this loss is because of liquidity. If you cannot convert your asset into cash immediately, that is a liquidity risk. Here, it was an asset, your debtors. Here, for banks, loan was your assets. So if you cannot convert your assets into cash immediately, that is a liquidity risk. Done? Any issues?
Yeah. Okay, sir.
Yeah.
Correct.
Next, let's look for operational risk. Operational risk is human error. It's always human error. So from bank point of view, the bank was supposed to pay 1 lakh and the employee who was sitting there paid 10 lakhs. The man withdrew the money and went home. You cannot even find him. That's the operational risk. Someone fraudulently put 100 CR out of the bank to someone else's account outside India. That is operational risk. So any human error, in any loss due to human is operational risk. Day-to-day operations. That is operational risk. Okay. Legal, you all know what legal and regulatory risk is. I'm not going to speak much about that, but yeah, they do impact. Regulatory means government. Government changes policy, the policy is against you, that is a regulatory risk. In 1970s, I suppose 71, Indira Gandhi tried to nationalize all the banks. Even the foreign companies, Indira Gandhi asked either 51% share should be Indian or you should get out of India. Coca-Cola went back, IBM went back, Unilever stayed back. So that was a regulatory risk. Business and strategy risk. Strategy is long-term decision risk. Now, Nokia had a long-term strategy of only having one SIM card in their slots because they wanted to sell more phones. When Samsung and other came up with two SIM cards, Nokia took long time to change their strategy, or Nokia did not come to Android. It was their long-term strategy to have their own operating system. And that was a strategic risk for Nokia that got Nokia bankrupt. So that was a strategy risk. Reputation risk, loss of your reputation. Best example, Adani Group. So that is a reputation. These are the types of risks. Do you have any questions on types of risk? Good. No questions. Let's move ahead then. Now, in market risk, we have seen what market risk is. There are 4 different types of risk. Interest rate risk. What is interest rate risk? Interest rates goes against you. That is interest rate risk. Now, I'm consultant to a cooperative bank, and now as interest rates is higher, almost 7 point, above 7, let's say 7.06. I had asked them to purchase high duration bonds. Why high duration? Because when interest rate will go down, the price will go up. Unfortunately, after we purchased high duration bonds, US still says that we are going to increase the interest rate. And rather than interest rate going down, interest rates started climbing up. So from 7.06, 7.07, and so on and so forth. And because they were high duration, the prices started moving down quickly. And as it was a cooperative bank, people started worried or getting worried that our capital is getting eroded. What to do? That is a basic example of interest rate risk. Equity price risk, your portfolio of let's say 10 million, all in equity, and the equity went down, the complete market went down by 10%. you lost 1 million. That is equity. None of these are in your control. Suzlon took a loan from Europeans at 3%, but they took loan in euro. And when after 5 years they were supposed to repay, euro appreciated by almost 15%. So Suzlon were supposed to pay 15 plus 3, 18%, and they almost filed for bankruptcy. They are coming back, but this was Suzlon way back in 2010-11. Commodity price risk, the prices of commodity changes, and then it goes against you. So these are all different types of market risks. I don't think so there is much to explain here. Let's move ahead. Credit risk. 4 types of credit risk. Default risk. You give loan and he defaults. That is default. Bankruptcy risk. You give loan and he filed for bankruptcy. He files for bankruptcy. And then litigation keeps on going. Downgrade risk. You give loan to a company and you find out that, okay, the company is not doing well and credit rating agency has downgraded it. That is downgrade. Settlement risk. Okay, you were supposed to give 100 rupees to company A and you were supposed to receive 120 from A. Let's say you are B. Right? And company A filed for bankruptcy. What will happen? You will not get this 120, but you will have to pay this 100. So effectively, you were supposed to receive just 20, but now you are paying this 100 also, and you suffered a loss of 120 here. And that is what settlement is. Has anyone heard about Herstatt Bank?
No, sir.
Okay. Have you heard about Basel norms, Basel 1, 2, 3? So these are banking regulation norms. And these norms came up when this bank failed. So let us speak about Herstatt Bank. Somewhere in 1970s, I'm not sure about the year, but somewhere in 1974, Herstatt was a German bank, and they were expert in foreign exchange. Now, due to some wrong bets, they made huge loss. But the day-to-day operation was going on. As their fee was less, every day they used to transfer almost 1 billion from Europe to America. On the day of bankruptcy, many people from Germany paid money to Herstatt Bank so as the bank in USA, the same Herstatt Bank in USA, could give it to the clients in USA. On the day of bankruptcy, people gave almost $1 billion to Herstatt Bank at evening 4:30 in Europe. That was almost 10 o'clock in America. Banks were yet to open. Herstatt Bank took $1 billion from these people and they were never remitted it to USA because they filed bankruptcy at 4:30 and the banks in USA were yet to open. This $1 billion, approximately $1 billion, which was deposited on Herstat Bank on the day of bankruptcy, so as that money should go to USA and the people in USA could get it, that 1 billion could never go to the people in USA. And Herstat Bank filed about. So one came in 1988, I suppose, almost 14 years this thing happened. And what is Basel? These are rules for banking regulations. So we will see Herstat again, we will see Basel 1, 2, 3 again, what are the norms of Basel and all that in FRM. But Herstat is a name of bank. You can Google it, you can see it, how things went. And settlement risk is one of the type of credit risk. So these are the 4 different types of credit risk. Let's move ahead. Liquidity risk. I have told you about liquidity risk, but there are 2 different types of liquidity risk. First is funding liquidity risk. That is inability to pay loan. And second is market illiquidity risk. I purchase an asset for 100 and I am unable to sell it. That is market liquidity risk. Temporary inability to find a counterparty. That is market liquidity risk. Let's move ahead. Operational risk. These are due to human error. We have already seen this. Now, every bank will have to decide which risk they should take. These are few well-known banks of the world, and they are willing to take credit risks. You will see this blue. These are credit risk graphs. Very few of them are willing to take operational risk. So operational risk should be almost less than 50%. So they have taken a lot of credit risk. They have taken medium operational risk, and they have taken very less market risk. Now, most of the banks, they work on credit risk. So they give loan and they're ready to receive the loan back. Only few banks are good with market risk. JP Morgan is one of the bank who are ready to take market risk. We will see how you can take market risk, how you can take operational risk, and so on and so forth. Legal risk, we already seen that. I'm rushing. Business and strategy. Strategy is for long term. Business is variability due to profit and revenue. So if cost increased, your revenue decreased, that's your business risk. Reputation risk, loss of reputation. We already seen that. Okay, just a sec. Yeah, you have risk adjusted return on capital. Now, if you are from finance background, you must be knowing what is return on capital, which is nothing but your profit upon your capital invested. Now, when you say risk adjusted return on capital, what you do, you subtract the risk value from the profits. So if your profit is 100 and you feel that your risk is 20, then you subtract 20 from your net profit. So your risk adjusted profit is 80. And now you divide it by capital, and then you get risk adjusted return on capital. No examples here. We are just understanding the concepts. Done. This is the first chapter which we have covered. Now we are moving to second chapter.